Hello and welcome to The Explainer. Today we're going to talk about something that can sound very big and, well, a little complicated: the financial system. But I promise you, we're going to make it all very simple. Let's begin.
Namaste, students. Now, I know when you hear words like finance or equities, it can seem a little difficult, no? But please don't worry about that at all. We are going to go very, very slowly, one step at a time.
So, on one side, you see this idea of a big, scary system. It looks so complex. But on the other side, just think of a simple vegetable market. Now, you might be thinking, how can these be the same? But believe me, they are really very similar. In both, you have buyers, you have sellers, you have goods being traded, and you have a place for everyone to meet. The financial system is really just a very, very big market. That's all.
So, what is the main job of this big market? Well, at its heart, the job is very simple. It's like a bridge. It connects people who have some extra money saved up, let's call them savers, with people who need money, maybe to build a business or a new house. We can call them borrowers. It's just a way to move money from those who have it to those who need it. Simple, isn't it?
Okay, very good. So if the financial system is a market, what are we buying and selling? It's not vegetables, of course. We are trading something called assets. So let's find out what these assets are. The first type of asset is something we call fixed income, and the most common kind is a bond. Now just think of a bond as a very formal, written promise. It's like a proper IOU note. Someone borrows money from you, and this bond is their written promise that they will pay it back, and they will also pay a little extra as a thank you. That little extra is called interest.
Let's use a very simple example. Imagine the government wants to build a new train line in your city. They need a lot of money for that, right? So you give them, say, 100 rupees to help. In return, they give you a certificate, a piece of paper. That's the bond. And it promises to give you your 100 rupees back in 5 years. And for your help, every year they'll give you a small amount of money, maybe 5 rupees. That, my students, is a bond. You're simply lending your money for a project. So, a quick question for you to think about. From our example, is buying a bond more like lending your money, or is it like owning a small piece of the train line? Yes, that's right. It's like lending. You are a lender, not an owner. You get your money back, plus interest, but you don't own the train itself. Very good. Now let's look at the second type of asset. These are called equities, but you probably know them as stocks or shares. Now, this is very different from a bond. When you buy a stock, you are not lending money. No, you are actually buying a small piece of a company. You become a part owner. Let's imagine there's a sweet shop near your house. You know, the one that makes the best ladoos. The owner wants to make his shop bigger, so he offers you a chance to become a small partner. You give him some money, and now you own a tiny part of that shop. If the shop does very well and sells lots and lots of ladoos and makes a good profit, then your small share in that shop becomes more valuable. That is exactly how a stock works. All right, another question for you. If you are a part owner of the sweet shop, is the owner promising to give your money back on a specific day, like the government promised with the train line bond? No, correct? There is no such guarantee. If the shop does well, your share can be worth a lot of money. But if it doesn't do well, you might even lose your money. That is the key difference to remember. A bond is a loan, but a stock is ownership. Very good, everyone. So now we know what we are trading: bonds and stocks. The next question is, where does all this trading happen? Let's go to our next section and explore the markets. Okay. So there are two main types of markets. We have the primary market and we have the secondary market. In the primary market, the company itself is selling its shares for the very first time, and the money you pay goes straight to the company. But in the secondary market, it's different. Here, investors who already have the shares are selling them to other investors. The money just goes from one investor's pocket to another. The company is not directly involved. Let's go back to our sweet shop to make this really clear. When the shop owner sells new partnership shares for the first time to get money to build a bigger kitchen, that is the primary market. But later, let's say you decide to sell your share to your friend. Well, that happens in the secondary market. The sweet shop owner doesn't get any money from that sale, does he? No, it's a trade just between you and your friend.
Now you can imagine, in such a big market, it might be hard to find a buyer or seller all on your own. So we have some special helpers who make everything much easier. In finance, we call them intermediaries. Let's meet them. First up, we have the broker. A broker is just an agent, a middleman. Their job is to be a matchmaker. If you want to buy, they find someone who wants to sell. Simple. And the important thing is, they don't use their own money for the trade. They just connect the two parties. A perfect everyday example is a property agent. You know, the person who helps you find a house to rent or buy. Does the agent own all those houses? Of course not. He just knows who wants to sell and who is looking to buy. He connects them, and for this service, he gets a small fee. A stockbroker does the exact same job, but with stocks and bonds. All right, next we have the dealer. Now, a dealer is very different from a broker. A dealer actually trades using their own money. They will buy shares and keep them in stock, like an inventory in a shop. Then, when a buyer comes to them, the dealer sells those shares from their own stock. The best way to understand a dealer is to think of your local Kirana shop owner. Does he wait for you to order a bar of soap before he calls the company? No. He buys many, many soaps from the big company and keeps them in his shop. So when you need one, you can go and buy it from him immediately. A dealer does the same thing with stocks. So, another question for all of you. Let's say you have to sell your shares, and you have to do it right now, very quickly. Who can help you faster? A broker who has to go and find another person who wants to buy, or a dealer who can just buy it from you directly for his own shop? The dealer, exactly, because he can buy it from you himself immediately. This ability to buy or sell something quickly has a special name. We call it liquidity. It's just a fancy word for how easy is it to sell. Fantastic. You're all doing so well. Now, just like in any game, there are some simple rules or instructions you need to know when you're ready to buy or sell. Let's look at two of the most basic instructions. Here are the two main types, a market order and a limit order. A market order is when you tell your broker, just buy this for me right now, whatever the best price is. It's very fast, but you don't know the exact price you'll get. A limit order is when you say, I only want to buy if the price is this much or even lower. This gives you price control, but there's a risk. The trade might not happen at all if the price never drops to your limit. And just like that, you have understood the basic building blocks of the entire financial system. You see, it wasn't so scary, was it? Let's just do a very quick review of what we learned today, because your journey into finance is really just beginning. So what was our journey today? First, we saw the system is just a bridge between savers and borrowers. Then we learned what we trade, bonds, which are loans, and stocks, which are ownership. We found out where we trade, in the primary and secondary markets. We met the helpers, the brokers, and the dealers. And finally, we understood a simple rule of the game, market orders versus limit orders. 5 simple steps. That's all. You know, this system, this big market, it really powers our whole world. From the trains we take to the shops we visit, it can seem complex from the outside, but as you saw today, it's all built on very simple, very logical ideas. So the only question left is, now that you know the basics, are you ready to learn how to navigate it? I think you are. Well done today, everyone.
Hello, everyone, and a very warm welcome to all of you. My name is James. Today, we are going to learn about something called security market indexes. I know, the name sounds very big and complicated, doesn't it? But please don't worry, I promise you it is much, much simpler than it sounds. We will go through it all together, step by step.
So what is an index? The book says it is an indicator or a measure. But what does that mean in simple words? Let's think about a cricket match. Okay? Let's say India is playing. Now, do you need to watch every single ball of the match to know the score? No, of course not. You can just look at the scoreboard, right? An index is just like that. It is the scoreboard for the stock market. One look and you get the whole picture.
So here is our lesson plan for today. We will go through this one by one, nice and slow. First, we'll understand what a market index really is. Then, we will look at two different ways to measure returns. After that, we'll see how these indexes are actually put together, how they are kept up to date, and finally, why they are so very important for all of us. Shall we begin? Let's start.
Okay, so Section 1. Let's look a little bit more closely at this idea. The idea of a market index being the scoreboard of the market.
You see, an index is really just a group, a basket of different company stocks. And these individual stocks that are inside the basket, they have a special name. We call them constituent securities. Let's go back to our cricket team. The team has a total score, yes? But that score is made up of the runs from each player, Dhoni, Kohli, everyone. So the individual players are like the constituent securities. And the team's final score? That's the index. So, you see, an index is really just a summary. It is telling us in one single number how a whole group of stocks is performing. It's not so difficult, is it? Good. Now that we know what an index is, let's look at how we measure how well it's doing. And that brings us to our second topic, price return versus total return. Now, to understand this, let's forget the stock market for just a minute. I want you to think about a small shopkeeper in your neighborhood. Okay, now on this slide, we see the difference. On one side, we have price return. This is like our shopkeeper only looking at the price tag on his items. If the price of a soak bar goes from 10 rupees to 12 rupees, that 2 rupee change is the price return. Simple. But a smart shopkeeper also earns a profit, doesn't he? And he might take that profit and put it back into the business to buy more soap to sell. That extra income is like a dividend in the stock market. So total return is the full picture. It looks at the price change plus any extra income like dividends. So, I have a simple question for you all. Which one do you think gives a more complete, a more true picture of how your investment is doing? Price return or total return? Yes, exactly. It's the total return, because it includes everything, the price change and the income. It tells the full story. Well done.
Let's move on to Section 3. We're doing very well. Here we will talk about how indexes are weighted. Let's think about our cricket team again. When a star batsman like Virat Kohli scores 100 runs, it has a very big impact on the team's total score, correct? It's much bigger than if a bowler scores just 10 runs. Well, in an index, some stocks also have a much bigger impact than others, and this is what we call weighting.
Now, there are a few common ways to decide which stocks get more importance or more weight. In a price-weighted index, it is very simple. The stock with the highest price for one share gets the most weight. In an equal-weighted index, every stock is treated exactly the same. It's fair for everyone, just like in an exam where every student gets the same amount of time. And then there's market cap weighted. Here, the biggest companies, the ones with the highest total value in the market, have the biggest influence. Now please look carefully at this table. This is a very, very important idea. We have the same three stocks, okay? Stock A, B, and C. But look what happens when we use different methods to calculate the index. See this first column, price weighted? Stock A is almost half the index. It has all the power. But now look at the last column, market cap weighted. Suddenly, stock B is the most important one. And in the middle, equal weighted? Well, everyone is the same. See? The method changes everything.
So the most important point for you to remember is this. The way you decide to build the index, the weighting method you choose, it completely changes which companies have the biggest voice. It decides which company gets to be Virat Kohli and which one is the last batsman. So the method of calculation is absolutely crucial.
Very good. You are all doing so well. Now, let's go to Section 4. We need to talk about how we keep these indexes up to date. Just like a cricket team, right? Before a big tournament, the team captain and coach have to update the list of players and their strategy. It is exactly the same for an index. So, first, we have something called rebalancing. You know that stock prices go up and down every single day. Because of this, the weights of the stocks in the index also keep changing, moving away from the original plan. So, rebalancing is just the simple process of adjusting everything back to how it was supposed to be. It's like a coach in a match telling the players, okay, everyone get back to your original positions.
And then we have something called reconstitution. Now, this is a much bigger change. This is when we actually change the stocks that are in the index. A company that is not performing well might be removed, and a new strong company might be added. This is just like in cricket when you substitute a player who is tired or out of form with a fresh new player.
All right, we have reached our final section, Section 5, and this is the most important part. Why do we even learn all this? Why does any of this matter to you? This is where we see how you will use this knowledge in your careers.
So these indexes have many uses. They help us understand the mood of the market. Are investors feeling happy and confident, or are they feeling nervous? Indexes are also used as a model to create new investment products, things you may have heard of like mutual funds or ETFs. But perhaps their most important job is to act as a benchmark. A benchmark is just a standard, something you use to compare and measure against.
Let me make it even simpler for you. Imagine you give your money to someone, a fund manager, to invest for you. Now, how will you know if they're doing a good job? You will compare the results to the index. If the index went up by 10% in 1 year, but your manager only made you 5%, well, then you know they are not doing a good job. The index is like their school report card. It tells you if they get an A grade or if they fail.
So today we have learned that indexes are our scoreboard, our map for the financial markets. They are so useful to help us understand what is going on. But I want to leave you with one final thought to think about later. If everybody is using the same map, and they all make the same decisions based on that map, like buying a stock just because it is going to be added to an index, then can their actions start to change the market itself? What happens when the map starts to change the territory? It is something interesting to think about. Thank you all so much for your attention today. You were wonderful students. Hello, my dear students, and a very warm welcome to all of you. My name is Jennifer, and I will be your teacher for today. Now, we are going to tackle a very important topic for your CFA exams, market efficiency. Don't worry, I know it sounds a bit complicated, but I promise you, by the time we are finished, you will understand it very clearly, okay? Let's begin. So, this is our plan for today. Think of it like a roadmap. First, we'll ask, what is market efficiency? Then, we will look at the difference between price and true value. After that, we will learn about the 3 forms of efficiency. Then we'll see, why does any of this matter to us? And finally, we will look at some interesting times when markets seem, well, a little bit irrational. Shall we start? Okay, so, part 1. What is market efficiency? Now, to understand this big idea, we are not going to open any big, heavy textbooks. No. We are going to start with a very simple everyday example. Let's imagine we are going to the Sabzi Mandi.
So, what does this efficient market mean? Just imagine you are at the Sabzi Mandi, okay? You want to buy tomatoes. One seller is selling for 30 rupees a kilo. But suddenly, another seller drops his price to 10 rupees. What happens? The news will spread like fire, no? Everyone will know in just a few seconds that the correct price for tomatoes is now 10 rupees. An efficient stock market is just like that. Any new information, it gets reflected in the stock price almost instantly. This means it's very difficult to make easy profits.
All right, that was a good start. Now this brings us to another very important idea. We need to understand the difference between the price of something and its real, true value. Let's use a cricket example. We all love cricket, isn't it? Imagine a cricket bat in a sports shop. The price tag says 1,000 rupees. This is its market value, what you can buy it for today. Simple. But what if you have a special piece of information? What if you know that this is the exact bat that Sachin Tendulkar used to score a century? Ah, now its intrinsic value, its real, true worth, is much, much higher, no? So you see the difference. Market value is just the price tag. Intrinsic value is what it should be worth if you knew everything about it.
So, now a simple question for you. If you are an investor, someone who is actively looking for good stocks, what is your main goal? What are you trying to do? Think about it. Yes, you are trying to find those Sachin Tendulkar bats. You are looking for things where the market price is much lower than the real intrinsic value. That is the whole game of investing.
Very good. Now we come to the main theory of this chapter. It's not so simple as saying a market is efficient or not efficient. Actually, there are different levels or different forms of efficiency. Let's see what they are.
Don't worry, there are only 3 forms. You can think of them like 3 boxes, one inside the other. The second box has everything the first box has, plus some more. And the third box has everything the second box has, plus even more. It's simple, really. Let's look at each one by one. So here you can see the 3 forms: weak, semi-strong, and strong. And what makes them different is the type of information that is already included in the stock's price. Is it past data? Is it public information? Or is it even private, secret information? Let's break them down now. Okay, first is the weak form. Weak form efficiency means the current stock price, it already has all the past price information inside it. It's like this. Can you look at all the old cricket scoreboards from past matches and predict exactly what the score will be tomorrow? Of course not. It's the same here. If a market is weak form efficient, then just looking at old price charts, what we call technical analysis, is not going to help you make money. Next, we have semi-strong form. Now this one is a bit more, strong. It says the price reflects all publicly available information. So all the news, all the company reports, everything. Imagine your team's best player gets injured right before a big match. The second that news comes out on TV, everybody knows it, right? The team's chances of winning change instantly for everybody. It's too late for you to use that news to make a profit. It's the same in the stock market. If a market is semi-strong efficient, even reading all the public reports very carefully, it probably won't help you beat the market again and again. And finally, we have the strong form. This is the strongest of all. It says the price reflects all information, not just public, but private, secret, insider information also. This would be like knowing that a match is fixed before it even starts. Of course, you could make a lot of money, but this is illegal, isn't it? We call it insider trading. And that is why, in the real world, no market is truly strong form efficient. It is more of a theoretical idea. Okay, so that's the theory. Weak, semi-strong, strong. But you must be thinking, Jennifer, ma'am, why are we learning all this? Why does it matter? And that's a very good question. This is where it becomes very, very practical for us as investors. So, here's the main point, the bottom line. The more efficient a market is, the harder it is to beat it and make extra profits. If the market is weak form efficient, then studying charts won't really help. If it is semi-strong form efficient, then even studying all the company reports, what we call fundamental analysis, won't give you a big advantage. And this is exactly why many people choose something called a passive strategy. They just buy a little bit of all the big companies in the market, like an index fund. It's like saying, look, the market is very smart, it's too hard to beat, so I will just go along with it. It's also much cheaper. Now, I know exactly what you're thinking. You're thinking, but wait, sometimes the stock market seems completely crazy. Prices go up one day, down the next, for no good reason. And you know what? You are absolutely correct. This theory is not perfect. So now, let's talk about those times when the market seems, well, a little bit irrational.
You see, clever people have studied the markets for many, many years, and they have found some strange patterns, things that happen again and again, which don't really fit with this theory of efficiency. These strange exceptions, they have a special name. They are called market anomalies. An anomaly is just a word for something that is a bit peculiar, a bit strange.
So what are these anomalies? Well, for example, for a long time there was something called the January effect. For some reason, stocks of small companies used to do very well in January. Then there is the value effect. Stocks that seem cheap based on numbers like the price-to-earnings ratio, they often performed better than expensive stocks over the long run. But I must give you a small warning here. These are just observations from the past. There is absolutely no guarantee that these things will continue to happen in the future.
And this is a very, very important point. Look at this quote from The Economist. It says that once everybody finds out about one of these anomalies, what do? They all try to use it to make money. And when everybody rushes to do the same thing, the opportunity, it just disappears. Poof, it's gone. Especially when you think about the cost of buying and selling stocks.
So, why do these strange things happen in the first place? Well, this question brings us to a very interesting new subject called behavioral finance. You see, it reminds us that the people buying and selling stocks, they are not computers or robots. They are human beings. And we humans, we are not always perfectly logical. Sometimes we are overconfident. Sometimes we just follow what everyone else is doing, like a herd of sheep. And we really, really hate losing money, more than we enjoy making it. All these human feelings and biases, they help explain why the market can act so strangely sometimes.
So, my dear students, we will end with this final question for you to think about. After everything we've learned, what do you think? Is the market a perfect, cold, calculating machine that processes all information instantly? Or is it more like a big, complicated, very human puzzle full of emotions like fear and greed? The real answer, I think, is somewhere in the middle. And if you can understand this tension between logic and emotion, that is what will make you a wonderful financial analyst. Thank you so much for listening.
Hello, my dear students, and welcome. My name is Jennifer. I know many of you are starting your CFA journey, and maybe finance feels a little confusing? Please do not worry. We are going to take it one step at a time, very slowly, and I promise you, you will understand everything. So, shall we begin?
You see, my promise to you is very simple. For every new idea, every difficult word, we will use an example from our daily lives. It's just like a shopkeeper, balancing his hisab kitab, his account book, at the end of the day. At first it looks complicated, no? But once you understand the system, it's actually very simple. And we will learn this system together.
Okay, so let's start with our first section. What is an equity share? This is the most important idea, the very foundation. We must understand what it means to own a small piece of a company.
All right, now if you open your textbook, you will see a definition like this. Equity securities represent ownership claims on a company's net assets. Oh my goodness, so many big words. Ownership claims, net assets. Please don't worry about these words right now. Let's just forget them for a moment and think in a much simpler way. I want you to imagine a big, tasty cake, okay? Now, that whole cake, that is the company. And if I cut one slice and give it to you, that one slice is like one equity share. It's as simple as that. It means you own a small piece of the whole company. You have become a part owner. Just like two friends who start a small Corona shop together. Each is a part owner. See? It's simple, isn't it? Now think about when we go to the railway station to book a ticket. There are so many types of tickets, no? There is sleeper class, there is third AC, second AC. Each one is a different type of seat on the same train. In the same way, there are different types of shares. For our CFA studies, the two main types we must know are common shares and preference shares. So, moving on to our second section, common versus preference shares. You might be asking, Jennifer, ma'am, what is the difference? Well, the difference is all about two very simple questions. First, who has more say in how the company is run? And second, when the company makes a profit, who gets their money first? Let's think about our Kirana shop again. The people who own common shares, they're like the family members who started the shop. It is their business, right? So, naturally, they get to make the decisions. They have a say in how the business is run. They can vote on important things, like who will be the manager. This voting right is the most important thing to remember about common shares. Okay, now what about preference shares? Well, imagine a respected uncle from outside the family gives the shop some money to expand, to grow bigger. He's an investor. He is given preference or special respect. He doesn't want to run the shop day to day, so he usually doesn't have voting rights. But he has one condition. When the shop makes a profit, he must be paid his share first, before the family members take their profit. He gets preference. Look at this table. It makes it all very clear. See? Voting rights. Yes for common shares, but usually no for preference shares. And what about getting paid profits? The technical word is dividends. Who gets paid first? The preference shareholders. Because they get paid first, their risk is also a little bit lower. It makes sense, no? Okay, so now a small question for all of you, my dear students. Let's imagine our little shop has made a very good profit this year. Now tell me, who will get their share of the money first? The family member who has the common share, or the respected uncle who has the preference share? Think about it. Yes, correct. The preference shareholder. Very good. You are understanding perfectly.
Excellent. So now we know what shares are, but a good question is, where do we go to buy them? This brings us to our next section, number 3, public versus private equity. Let's understand the difference.
You know, public equity is just like our big vegetable market, the mandi. Anyone can go there, right? You can see the price of tomatoes on a big board. It's open for everyone to see and buy. The stock exchanges like our NSE or BSE, they are like this big public mandi. But private equity, that is different. That's like a huge farmer making a direct deal with a 5-star hotel. It is a private deal, a negotiation just between them. It is not open for you and me.
And please, don't think this private market is small. It is absolutely enormous. Just look at this number, 3.6 trillion US dollars. That was the value of just one type of private deal called leveraged buyouts in a certain period. So you see, even though we hear about the stock market on the news every day, this private world of deals is incredibly important.
Okay, let's move to section 4. Now, you might be sitting in India and thinking, I really like this company in America, or maybe in China, like Alibaba. Can I own a piece of that company? Is it possible? And the answer is yes, absolutely. Let's find out how.
The way we do it is by using something special called a depository receipt. Now I know the name sounds very complicated. Depository receipt, what is that? But don't worry. It's just a fancy name for a very simple idea. It is a tool that makes buying a foreign share just as easy as buying a share of an Indian company.
So let me explain how this works. It's a very clever process. Look at step 1. A very big, trusted bank goes and buys, say, 1 lakh shares of Alibaba in China. Then, step 2, the bank keeps those shares safely in a locker and issues 1 lakh small receipts, like tokens, here in India. Now, step 3, you and I can buy and sell these little tokens on our own stock exchange, the NSE or BSE, using our own rupees. It's like trading the real share, but much, much easier.
Okay, so this brings us to our final section for today, section 5. We know what a share is, where to buy it, but the biggest question of all is, how much is one share worth? And to understand this, we need to look at 2 different things. what the company's account book says its value is, and what price people are willing to pay for it in the open market. Let's start with book value. This is the simple value from the account books. Let's go back to our shopkeeper. Imagine at the end of the year, he makes a list of everything the shop owns, all the goods, the furniture, the cash. This is called assets. Then he makes another list of all the money he has to pay to others, his loans. This is called liabilities. He simply subtracts the liabilities from the assets, and whatever is left, that is the book value. It's the shop's net worth on paper. But now, look at this table. This is where things get really, really interesting. Look at the company Pfizer. Its book value per share was around $12, but the market price, what people were actually paying for it, was almost $36. That is 3 times more. So my question to you is, why? Why are people willing to pay so much more than what the account books say it is worth? Well, the world's most famous investor, Mr. Warren Buffett, he gives us the answer. He says the real value of a business is all the profit, all the cash it is going to make in the future, for the rest of its life. That word discounted in his quote, it just means that 100 rupees you might get in 10 years is not as valuable as 100 rupees in your pocket today, right? So the market price is not about today's book value, it's about everyone's hope and expectation for all the future profits.
So if the future is so important, how can we check if the company's management is doing a good job with the owner's money today? For this, we have a very simple report card. It is called Return on Equity, or ROE. The idea is so simple. It just asks this question. For every 100 rupees the owners have put into the business, how many rupees of profit did the management generate this year? So a company with a high ROE is like a student who gets very good marks in the exam. It shows they are working hard and efficiently.
And just like that, you have completed your first step. It wasn't so difficult, was it? These ideas, they are the absolute foundation, the ABCs of everything else you will learn. So please, give yourself a pat on the back. Well done. Just take a moment and think about everything we have learned today. You now know that a share is just a slice of a big cake. You know the difference between common and preference shares, the family member versus the respected uncle. And you understand the difference between the shopkeeper's account book and the price in the big market. Truly, you are doing very, very well. So you now know what equity is. But the biggest question, the question that every future CFA charter holder must learn to answer, is this. How do you find its true value? How do you calculate if that $36 market price for Pfizer was too high, too low, or just right? That is the next step in our great adventure together. Thank you so much for listening to Hello, students! Welcome! Today we will learn something very important, but do not worry, it is very simple. We are going to learn how to understand any company, just like a doctor understands a patient. Think of it this way. Before you decide to trust something, you must check it properly, no? That is all company analysis is. We're doing a full health checkup on a business. This is our simple plan for today. We will go step by step, and I will be with you all the way. Okay, let's dive into this. First things first, we must understand our patient. Who are they? What do they do? This is what we call the business model. It's like an identity card for the company. For example, a local Kirana shop's business model is very simple. It sells household items to people in the neighborhood. You see? This is the exact checkup we will perform today. These 4 simple steps will tell us everything we need to know to start. Remember these steps, they are our guide. All right, now let's move on. Let's check the patient's pulse. In finance, the pulse of a company is its revenue. Imagine a shopkeeper's gala or cash box. At the end of the day, the total money collected from all the sales, that is the revenue. Simple, no? A quick question for you all. That's right, 5,000 rupees. Wonderful. You are getting it. Now, you can count the money in 2 ways. Bottom up is like counting every single mango your fruit seller sold. Top-down is like guessing his share of all the mangoes sold in the entire market. Both are useful, and this shows us, for a real company, Warehouse Club, most of its sales come from packaged food. This helps us understand their business better. A company earns revenue, but it also has to spend money. What is left after all the spending is profit. This is like the company's metabolism, how efficiently it uses its energy. Think of a shop's monthly rent. Whether the shopkeeper sells one biscuit packet or 1,000, the rent he pays to the landlord is the same. That is a fixed cost. Now, what about the cost of the biscuits themselves? To sell more biscuits, the shopkeeper must buy more from the factory. This cost changes with sales, so it is a variable cost. Understood? Think carefully. His profits will increase very fast because his main fixed cost, the rent, did not go up. This is a very important concept. So, the crucial point is controlling fixed costs is key. This is so interesting. The company makes very little profit on each item sold. Its real profit engine is the annual fee customers pay, just like a subscription for your mobile phone. Finally, let's check the company's overall strength, its bones and muscles. This is its capital, the money it uses to build and run the business. Where does a new business get money? Maybe from the owner's savings or a bank loan. These are sources. And what do they do with it? They buy equipment or stock. These are uses. Look here. This company mostly uses the money it earns from its daily business, and it spends about half of that money on growing the business and gives the other half back to its owners. This tells us it is a mature, stable company. This is like a student's report card. It tells us how well the company is using the investor's money to generate profit. Warehouse Club has a very good report card. Its ROIC is much higher than its cost of capital. So we have completed our first health checkup. You all did so well. Let's quickly revise what we learned. These are the 4 questions you must always ask. With these, you can begin to understand any company in the world. This is your power as an analyst. I want you to think about this. The best way to learn is by doing. Thank you for being such wonderful students today. Keep learning, and you will all be very successful.
Namaste, students. I'm James, and welcome. I am very, very happy to see all of you here today. Now, we're going to learn something that, it sounds a bit complicated, industry and competitive analysis. But I promise you by the end of our short time together, it's going to feel very, very simple. So, shall we begin? Okay, let's start with a simple question for you all. Think about it. Before a big cricket match, what is the captain doing? Is he only looking at his own players, at his own team's strengths? No, of course not, Beta. He has to check the pitch, he has to check the weather, and most importantly, he has to study the other team very, very carefully. Business is exactly like that. You just can't look inside your own company. You must understand the whole playing field, the entire industry. Is this idea clear?
So here is our plan for today. Let's think of it as our little journey together, okay? First, we'll understand the why the industries is so important in the first place. Then we'll define the where, the playing field. After that, we'll measure how big it is. Next, and this is very interesting, we'll learn the rules of the game. We'll also look at outside factors that can change everything. And finally, we will figure out the winning move. See? It's a simple, step-by-step path, so don't you worry at all.
Okay, first up, the why. Why must we always look at the industry first? Well, think of it like this. It is much more important to understand the whole forest rather than just looking at one single tree. A company's success depends so much on the industry it is in. You could have a great batsman, a wonderful player, but on a very bad pitch, he might not score well, correct? Well, the industry is the pitch for the company.
Now, this quote, it might look a little complicated, but the idea is actually very simple, I promise. It says that competition pulls a company's profit towards an industry base rate. So what does this mean?
Imagine in a cricket tournament, the average score for all the teams is, say, 150 runs. Sure, some teams might score 200 and some might only score 100, but over many, many matches, most teams will score somewhere near that 150 average. The industry, you see, it sets this base rate, this average for profits. Does that make sense? All right then, let's move to our second step, the where. We need to define our playing field. You see, before we can analyze the game, we must know exactly which game we are playing. And this just means we need to group similar companies together.
So, what exactly is an industry? It's really nothing more than a group of companies that sell similar things. It's so simple. Imagine you are a sabzi wala, a vegetable seller, and you are sorting your vegetables in the morning. You put all the potatoes in one basket, all the onions in another. That's all we are doing here, just grouping similar businesses together.
Now, for companies, we don't use baskets, of course, but there are official systems for this sorting. A very common one is called GICS. Don't worry about remembering the full name. Just think of it as the official rule book for sorting all the company vegetables into the right baskets, so that everyone, all over the world, agrees on where each company belongs. But here is a tricky question for you. What if a company is like a mixed vegetable curry? It has many different things in it. Just take Amazon, for example. We all think of it as an online shop, correct? But would you believe it makes most of its profit from something totally different, from cloud services, which is called AWS? So, which basket should we put Amazon in? This is a real challenge, you see, and as a good analyst, you must always be aware of these things. All right, our next stop on the journey is the how big. Now that we have defined our industry, our playground, the next step is to measure it. How big is this playground, and who are the main players on it? Just look at this number for a moment. $4 trillion. Can you imagine? That was the size of just retail sales in the U.S. in 2019. And that's without even counting cars. This is how we measure an industry's size, by looking at its total sales. It really helps us understand the sheer scale of the game we are analyzing.
Now, besides the size, we also need to know how many players are on the field. For this, we use a simple tool. It's called the Herfindahl-Hirschman Index, or HHI. Now, don't worry about the big name. All it does is tell us if an industry is dominated by a few very big players or if there are many, many small players. That's it. It's that simple.
Let's make this really simple. A high HHI, like we see for mobile networks in India, where we mainly have Jio, Airtel, and Vi, well, that means a few big players control everything. A low HHI is like the market for your local mobile recharge shops. There are thousands and thousands of them, no? No single shop can dominate that market. You see the difference now? And now we come to a very, very interesting part. The rules. We are going to use a famous idea from a man named Michael Porter. But I want you to think of it as just asking 5 simple questions to understand the rules of the game in any industry. So, these are the 5 forces. Let's try to understand them with a very simple example. I want you to imagine you are opening a small chai stall, okay? Are you ready? The first is new entrants. How easy is it for someone else to open a stall right next to yours? The second is substitutes. Can your customers just go and drink coffee instead? The third is customer power. Can your customers bargain with you for a lower price? The fourth is supplier power. Can the person who sells you milk and tea leaves suddenly increase their prices? And the fifth is rivalry. How tough is the competition from the other chai stalls already there on your street? Let's look at the first few a little more closely. So the first question, threat of new entrants. How easy is it for someone else to open another chai stall right next to yours? If it's very easy and it doesn't cost much money, then the threat is high. But if they need a special license that is very hard to get, then the threat is low. Simple, right? Second question, threat of substitutes. If people don't want your chai today, what else can they drink? Can they go next door and get a coffee, or maybe buy a cold drink from a shop? These other options, these are the substitutes.
The more choices your customers have, the higher the threat of substitutes is for you.
And the third question, bargaining power of customers. Think about it. If there are 10 other chai stalls on the very same street, can your customers demand a lower price? Yes, of course they can. They can simply walk away to the next stall. This means their bargaining power is very high. But if yours is the only chai stall for miles around, they will likely pay whatever price you ask. Their power is low. Understood?
Very good. Now, besides the rules inside the playground, we must also look outside of it. These are what we call the outside factors. So we need to ask, what is happening outside our industry, outside our playground, that could suddenly change the entire game? For this, we use another simple tool called pestle analysis.
Pestle just helps us look at the big picture. P is for political, E for economic, S for social, T for technological, L for legal, and the last E is for environmental. It's just like checking the weather forecast or maybe new city rules before a big cricket match. These are big forces that are outside your control, but they can affect your entire industry.
And here is a very simple example. There is a new social trend, right, where more and more people want to be fit and healthy. This trend has helped companies that make running shoes and track pants grow so much. This fitness trend, you see, is an outside influence, a pestle factor, that has helped the whole industry.
And here we are, at the final step of our journey together, the winning move. After we have understood everything, the industry, the players, the rules, and all the outside factors, we must ask the most important question of all. How does a company actually win in this game?
Well, fundamentally, there are two main ways to win. On one side, you have what's called cost leadership. This is like the big discount store that aims to be the cheapest and sells to everybody. And on the other side, you have differentiation. This is like that one special sweet shop in your city that makes the best jalebis in the whole world. People will happily pay more money because it is unique, it is special.
So here is the most important point I want you to remember from our class today. Whenever you look at any company, I want you to ask this one simple question. Is this company trying to win by being the cheapest, or is it trying to win by being the best, the most special? Answering this one question will tell you almost everything you need to know about its strategy. Think about it. This is your homework.
Hello, students, and a very warm welcome to you all. I'm your teacher, James. You know, sometimes we hear these big, complicated words like financial forecasting, and we think, oh, this must be very difficult. But I promise you, it's not. Today, we're going to learn about it in a very simple way. It's much easier than you think, so come, let's begin. So this is our lesson plan for today. Think of it as our roadmap. We will go slowly, one step at a time, so no need to worry at all. First, we will understand what is this financial forecasting. Then, we'll see how to forecast sales. After that, costs. Then, we'll even talk about planning for different futures. And finally, we'll understand why this is all so important for you. Ready? All right, our first topic. What exactly is this financial forecasting? Don't let the big words scare you, Beta. It is nothing more than making a smart guess. You know, just like when you look at the dark clouds in the sky and tell your mother, "Mummy, I think it's going to rain." You are making a guess based on what you see. In business, we do the same thing. We try to guess the future, but with a little bit of a plan.
Now, just think about this. Let's say you have saved some money, maybe from your pocket money or a part-time job. It's your hard-earned money, right? Now, if you want to invest it in a company, wouldn't you first want to guess where that company is going? Will it grow or will it struggle? Of course you would want to know. And that is why this topic is so very important for all of us. The easiest way to understand this? Let's think about our favorite game, cricket. When India is batting, how do the commentators predict the final score? They don't just guess randomly. No, they look at the current run rate, how many overs are left, which batsmen are still to come, right?
They use all this information to make a smart, logical guess. Financial forecasting is exactly like that. We look at how a company has performed in the past to make a logical guess about its future. See? It's not magic, it's just logic.
Okay, so now that we know what forecasting is, where do we begin? The first step, and really the most important step of all, is forecasting the sales. In very simple words, we're asking the question, how much money will the company actually make, from selling its things? This is sometimes called revenue. And believe me, every other calculation we do will depend on this one number.
So, to guess the sales, there are two main ways, two smart methods we can use. The first one is called the top-down approach. Think of it like this. You're looking at a big map of the entire country first, the big picture. The second one is called the bottom-up approach. Here, you start small. You start by looking at just one single house in your own colony. Let's take a nice, simple example to understand both.
All right, let's try the top-down method first. Imagine we are opening a small dosa restaurant in, say, Mumbai. First, we ask the big question. How much money do people in all of Mumbai spend on dosas in 1 year? Let's say we find out it's a huge market, 100 crores. Now, our restaurant is small, it's new, so we make a sensible guess. We think, okay, maybe we can capture just 1% of this big market. And what is 1% of 100 crores? It's 1 crore. And there you have it. That's our sales forecast. We started from the top, the whole city, and came down to our single shop.
Okay, now for the other way, the bottom-up method. For this, we forget the big city. We start small, right at our own shop. We stand there and we count. How many doses are we selling in just one day? Let's say we sell 500 doses. And how much is one dosa? 60 rupees. So we just multiply. 500 doses times 60 rupees gives us our sales for 1 day. Then we can calculate for a month and then for the whole year. And if you do the math, we will get a number close to 1 crore rupees again. See how we started from the bottom, one single dosa, and built our way up to the big number?
Okay, time for a small question for all of you just to make sure we are all on the same page. Imagine you want to open a mobile recharge shop. And to guess your sales, you stand outside and you count how many people walk by your shop every day. Now you tell me, is this top-down or is it bottom-up? Take a moment. That's right. You're starting with the small details, the individual people walking by. So it is the bottom-up approach. Very good, shabash.
Excellent work, everyone. So we have learned how to guess the money that will come in. But what about the money that will go out? A business has expenses, right? It's just like our family budget. Your father's salary comes in, but then there are so many expenses. The house rent, the school fees, the ration, the electricity bill. A business is exactly the same. We need to plan for the costs.
Now, before we look at costs, I want to teach you a new term. It is called working capital. Now, I know it sounds very big and difficult, but trust me, it's very, very simple. Working capital is just the money a business needs for its day-to-day running, for its daily kharcha. It helps manage the gap, the time between when you have to pay for your supplies and when your customer actually pays you. Let's take the example of our local kirana shop, our neighborhood baniya ki dukaan. We can understand this perfectly. When a neighbor comes and says, "Uncle ji, ye mere khate mein likh lo, put it on my tab," that money the customer owes the shopkeeper is called accounts receivable. Then look at all the things on the shelves, the biscuits, the soaps, the bags of rice. All of that is inventory. And finally, the shopkeeper also has to pay the big wholesale company that brings all these goods to his shop. That money he owes is called accounts payable. So simple, right?
Okay, now let's talk about some of the bigger expenses. We call them capital expenditure, or CAPEX for short. There are two types. The first is maintenance CAPEX. This is the money you spend just to keep things running.
Let's go back to our dosa restaurant. Imagine the tava, the big pan for making dosas, gets a crack. You have to fix it or buy a new one, right? Otherwise, you can't make dosas. That money you spend is maintenance capex. You are not growing your business, you are just maintaining it. And then we have this second type, the really exciting one. It's called growth capex. This is the money you spend to make your business bigger and better. This is not about fixing the old broken tawa. No, this is about buying a whole new restaurant in a different area of the city so you can sell thousands more dosas. This is a big investment to grow for the future. So now we have a plan for our sales and a plan for our costs. But tell me, does life always go according to plan? No, of course not. Sometimes things go much better than we hoped. And sometimes, well, things can go wrong. A smart person, a good analyst, always prepares for these different possibilities. And in finance, we have a name for this. We call it scenario analysis. It just means making a plan for different types of futures.
First, let's look at the best possible future. We call this the best case or the bull scenario. Why a bull? Because you know how a bull charges forward, full of power and energy? That's the idea. This is the plan for when everything goes perfectly. For our dosa restaurant, imagine a big celebrity posts a photo of our dosa on Instagram. Suddenly, everyone wants to come to our shop. Our sales go through the roof. This is our happy, optimistic scenario. Then we have the expected case. This is also called the base scenario. Now, this is our most realistic plan. This is what we actually think is going to happen based on our good, logical work. The business will run normally, it will grow at a steady pace, just like we planned in our original forecast. This is our main plan, our central roadmap.
And finally, we must also be ready for tough times. This is the worst case, which we call the bear scenario. You know how a bear goes to sleep in the winter? Everything slows down? This is the plan for when things go wrong. For our dosa shop, imagine there are very heavy monsoon rains, and the entire onion crop is spoiled. Suddenly, the price of onions doubles. Our costs will go up so much. This is our pessimistic plan, but it's very important to be prepared for it.
We are almost at the end of our class today. So, let's ask the big question. Why did we learn all of this? Why does this matter? Well, think of it this way. When you do all this hard work, guessing the sales, the costs, and thinking about the best and worst cases, you are not just making a guess anymore. You are actually drawing a map for your journey as an investor. It shows you the right path, but it also warns you about the difficult roads ahead. So, let's just quickly revise the simple steps we learned today. This is the thinking process of a smart analyst. What do? Step 1, they forecast the revenues, all the money that's going to come in. Step 2, they forecast all the costs and the big investments, the money that will go out. And step 3, they consider the different possibilities, the bull case, the base case, and the bear case. See? It's a very simple, logical, step-by-step process.
And please, my dear students, always remember this one thing. Financial forecasting is not magic. It's not about looking into a crystal ball like a fortune teller to see the future perfectly. Nobody can do that. What it is about is thinking in a structured way. It's about being like a good detective, asking all the right questions and slowly putting together the clues to see what the future of a business might look like.
I want to leave you with one final thought today. The main purpose of all this work is not to be perfectly correct every single time. That's just not possible. The real purpose is to be ready. Ready for the good times and ready for the bad times. So as you learn more and as you go out into the world, always ask yourself this question: what future will you prepare for? Thank you so much for your time and for listening so patiently today. I hope this was a helpful lesson for you all. Namaste, students, and a very warm welcome to you all. Today, we are going to learn something very interesting, something very important. we are going to learn how to find out the true value of a company's stock. I want you to think of us as detectives today, okay? We're going to look for clues to find what a company is really worth. So here is our lesson plan for today. First, we'll understand the difference between price and true value. Then, we will look at 3 different paths to find that value. After that, we'll talk about something called dividends and use a simple formula. We'll also learn how to find value just by comparing. And finally, we will see which tool is right for which job. Shall we begin our journey? Let's start. All right, let's begin with our first topic. This is the most important idea in all of investing, children. It's the difference between what you pay for something and what it is truly worth. So, let me ask you a question. When you look at the TV and you see a stock price flashing on the screen, is that number the real price? Is that what the company is actually worth? This is the big question, and finding the answer is what valuation is all about. It's actually very simple. Just imagine you are going to the sabzi mandi, the vegetable market. The price that the shopkeeper tells you, that is the market price. But the real value, the intrinsic value, well, that depends on how fresh the vegetables are, how good they will taste. Sometimes the market price is very high, but the quality is not good, so its intrinsic value is low. And sometimes you get a very good deal, no?
So, you see, if the market price is less than the true intrinsic value, we say the stock is undervalued. That is a good deal, a bargain. But if the price is higher than the true value, it is overvalued. It's too expensive. And if they are the same, it is fairly valued. Simple, isn't it? This is what we are always looking for.
Okay, very good. So now we all know that we must find this intrinsic value. But how do we do it? How can we find out what a stock is really, truly worth? Well, financial analysts have 3 main paths they can follow, 3 main methods. Think of it like this. Suppose you want to find the value of a house. One way is to calculate all the rent you could get from it in the future. That is like a present value model. Another way is to just see for how much your neighbor's house was sold. That's a multiplier model. And a third way is to add up the cost of the land, the bricks, the cement. That's an asset-based model. For our lesson today, we will focus on the first 2, which are very popular. So let's take our first path now, the present value path. This way of thinking is all about looking into the future, trying to guess all the benefits an investment will give you. And one of the most important benefits you can get from a stock is something called a dividend. Now, what is this dividend? Just imagine you gave your friend some money to help him open a small kirana shop. At the end of the year, his shop makes a good profit. Because you helped him, he gives you a small part of his profit. That small share he gives you, that is a dividend. It is the company sharing its profits with its owners, the shareholders. Now, paying a dividend happens in a few clear steps, just like how prizes are given in school. First is the declaration date. This is when the company announces, we will give a prize. Then there is an ex-dividend date. This is the cutoff. You must be an owner before this date. Then, on the holder of record date, the company makes the final list of all the students who will get the prize. And finally, on the payment date, you get the money. It is a very simple process, isn't it? I hope everyone is clear on how a dividend is announced and paid. It's important for what we are going to learn next. So, are we all ready to move on? Good. Very good. Now that we all understand what a dividend is, we can look at a simple formula. This formula uses these very dividends to help us calculate the intrinsic value of a stock. Now, please do not get scared when you see this formula. I know it looks a little complicated, but it is just like a cricket scoreboard. When you first see all the numbers, runs, wickets, overs, run rate, it can be confusing. But once you understand what each number means, the whole scoreboard becomes very easy. This formula is just like that. So let's break it down piece by piece. Imagine you are planting a mango tree. D1 is the first batch of mangoes you expect to get next year. R is your required return. It's the minimum number of mangoes you want for all your hard work. And G is the growth rate, how many more mangoes you expect the tree to give you every single year. See, it's a simple idea.
Okay, enough of theory. Let's try this with a real company, Siemens. I will give you the numbers, just like a math problem in school. The last dividend they gave was 3.70 euros. We expect the dividend to grow by 5.4%. That is our G. And our required return, our R, is 7.5%. So now we have all our numbers. We take them and we put them into our little formula. We do the calculation and the answer we get is 185 euros and 70 cents. This number, according to our formula, is the true intrinsic value of one share of Siemens.
But wait, we are not finished yet. This is the most important step. We must compare our answer to the market price. At that time, the market price was only 119.20 euros. So, our value is much higher, no? This means the stock appears to be undervalued. It's like we have found a treasure that other people don't know the value of. Does that make sense, everyone?
Excellent. You are all doing so well. Let's now look at the second path. This one is called multiplier models, and you will see it is much, much simpler. Here, we are not trying to guess the future. We are just comparing.
You know, the idea here is very simple, very intuitive. If you want to know the value of your flat, what is the first thing you do? You ask around. For how much did my neighbor sell his flat, right? We believe similar things should have similar prices. This method works in the exact same way. One popular tool for comparing is called the price-to-sales ratio, or PS ratio. It just compares the total stock price of a company to its total sales. It's like when you are buying a flat, you check the price per square foot. A lower price per square foot seems like a better deal, right? In the same way, a lower PS ratio can mean a stock is cheaper compared to its sales. Let's look at this table of car companies. You can see Toyota has a PS ratio of 0.80. General Motors is at 0.36, but just look at Peugeot. Its ratio is only 0.28. It is the lowest in the group. So, just by using this one comparison, it seems that Peugeot might be the cheapest. And maybe it is undervalued. So, we have learned two different paths now. One path is to look into the future with dividends. The other path is to compare with neighbors. This brings us to a very important question. Which path should you take? Which tool should you use? Well, the truth is, there is no one perfect tool. Think about a good doctor. When you go to a doctor, does he only use a stethoscope? No. He uses a stethoscope, a thermometer, he checks your blood pressure. He uses many tools. A good analyst is just like a good doctor. The present value path is good for stable companies that pay dividends. The multiplier path is very good for quick comparisons. A wise person uses many tools to get a full picture before making any decision. And that brings us to the end of our lesson. I am very proud of all of you. You have learned so much today. So let me leave you with one final question to think about. The next time you see a stock, what will you ask? Will you just ask, what is the price? Or will you ask, what is its true value? Thank you, students.